Hey guys, how's it going? Chris Leeper here, and today I want to talk about interest rates. They're still the headline topic in real estate. Every time they move, even slightly, people start asking whether the market is about to crash. But here's the reality across the Inland Empire, from Moreno Valley and Riverside to Menifee, Beaumont, and Paris. Rates are influencing the market, but they're not controlling it. So today I want to break down what interest rates are actually doing to the market in 2026 and how buyers, sellers, and investors are adjusting locally. Rates are higher, but they've stabilized. We're obviously not in the ultra low rate environment of 2020 and 2021, but something important has changed in 2026: stability. Buyers aren't reacting to sharp, unpredictable swings anymore. They're adjusting to a range that feels more consistent. That stability alone has brought more clarity back into the market. So buyers haven't disappeared. They've adjusted. Higher rates mean affordability has tightened. That part is real. But instead of vanishing, buyers are adjusting price ranges, negotiating more carefully, considering rate buy-down options, and expanding search areas within the Inland Empire. In cities like Paris and San Jacinto, where entry price points are still relatively accessible, demand remains steady. It's just more selective. But sellers are feeling the rate lock-in effect. Many homeowners are sitting on mortgage rates under 4%. That creates hesitation. If you have a low rate, trading it for a higher one feels expensive, even if your equity position is strong. That hesitation has limited new inventory in many Inland Empire communities. So while rates have cooled buyer urgency, they've also kept supply somewhat restrained. Now, inventory is up, but the market isn't flooded. We're seeing more inventory than the peak frenzy years. But we're also seeing longer days on market, fewer bidding wars, and more negotiation. But we're not seeing an oversupply. Homes that are priced correctly and marketed well are still selling across the Inland Empire. Overpriced homes are sitting. That's the real difference. Investors are also proceeding more carefully. Interest rates hit investors directly because financing affects cash flow. In 2026, investors are being more conservative, focusing on rent-to-price ratios, negotiating harder, and prioritizing stable rental demand areas. Markets like Moreno Valley and Menifee still attract long-term renters due to affordability compared to coastal counties, but investors are simply more disciplined now. So what happens if rates drop? A lot of buyers are waiting for rates to fall significantly. But if rates drop meaningfully, demand will likely increase quickly. That could increase competition with other buyers, reduce negotiating leverage, and will put upward pressure on prices. So waiting doesn't automatically mean better conditions. The market tends to adjust as it ebbs and flows. Interest rates are shaping the Inland Empire housing market in 2026, but they aren't defining it. They've slowed momentum, they've increased negotiation, and they've shifted expectations. But transactions are still happening every day. If you're trying to understand how today's rate environment impacts your specific situation, whether you're buying, selling, or investing, clarity around your numbers matters more than reacting to headlines. Thanks for tuning in. We'll see you on the next one.